Okay. Good morning, everyone. Again, thank you for joining us today. We have a great panel lined up for you today to discuss managing capital needs of portfolios impacted by the pandemic. So we're looking forward to getting to that discussion. Before we do, there are a few housekeeping things that I'd like to get through. So bear with us. For those who don't know, my name is Lena Dobrier. I am the Director of Operations at Opus Connect. We are a lower, middle, and middle market M&A focused organization. We are membership based, members in fields of private equity, investment banking, lending, independent sponsors. We hold monthly seminars in our various chapters, LA, Chicago, and New York. And in addition to those, we do deal sourcing events all around the country. So if you're interested in learning a little bit more about Opus Connect, please feel free to reach out to my colleague. His contact information is at the bottom of the screen here. Jacob Zephyrin. He'll be more than happy to answer any questions you might have. A few more points here. As we move to the next slide, we might be taking live Q&A. We'll see how the discussion goes. I'll let our moderator decide. But as questions come to mind, please feel free. At the bottom of your screen, you'll see a Q&A box there. Go ahead and submit your questions there, and we'll field those and try to get to as many as possible during the discussion or at the end. If you are a sponsor, please raise your hand. I'm going to go through our sponsors. Of course, these events would not be possible without their support, so I definitely want to give each of them a brief moment to introduce themselves. We're going to start with Alliant here, and I'm not sure if we have anyone, but I'm going to see if we do. Alliant, if you're in here, raise your hand. I don't believe you are. But they are our insurance sponsor in our Chicago chapter. They're sponsoring today's Dallas event as well. So we definitely want to thank them. We'll move on to the next one here. Kerry Maitland of Baker Tilly is going to introduce himself and say a few words here. So let me, there you are, Kerry. Oh, Kerry, are you there?
Yes. Can
Awesome.
You guys hear me?
Yeah.
Great. Super. Yeah, thank you. So I'm sorry I joined a little late. I just joined about a minute ago. I think I was in the wrong, I clicked the wrong Zoom link, but now I'm in the right one, it sounds like. So
great.
Yes, let's see here. Is it too late to change the contact info?
No. If you could just introduce yourself, we're live now to the audience. If you could just introduce yourself and Baker Tilly, say a few words, and then we can
super.
follow up afterwards.
Yeah, absolutely.
Awesome.
So this is Kerry Milant. I am a managing partner for the consulting practice of Baker Tilly, based here in Dallas. And Baker Tilly is a full service tax audit and consulting firm. We have a long and a long and in-depth history in the private equity and M&A transaction space. We offer really a full suite of services that cater to private equity professionals. And yes, that includes financial due diligence, commercial due diligence, M&A tax structuring, valuation work. We have a dedicated fund administration team. We have a number of different services. As I said, we are full service and we have offices throughout the country. And so we are very happy to be an ongoing sponsor of Opus. So thank you, everybody with Opus. Thank you very much for letting us participate. We're very happy to be here.
Awesome. Thank you so much, Kerry. We'll move right along here to Sapient Investigations. David Kogan, if you could introduce yourself and your firm, please.
Good morning. This is David Kogan. I'm the Managing Director of Sapient Investigations. We're a Southern California-based corporate intelligence firm. We've happily been a sponsor of Opus since the inception 10 years ago. And it's been amazing to grow with them. We're basically on the human side of due diligence. Basically, our private equity practice is essentially in due diligence. We do executive background checks. We look at management teams for M&A. We do joint venture. We look at joint venture partners and do background checks with them. We also have a very robust business dispute team, and we do a lot of litigation-related work, proxy fights and the like. Anyway, it's always great to be here, and hopefully we can get a chance to chat and get to know all you guys.
Yes, thank you so much, David. Appreciate that. We'll move right along here to Focus Search Partners. Steve, I see you here. Please introduce yourself and your firm.
Thank you, Lena. Steve Finder. I lead the.
Steve, if you could speak up just a little, we're having a little trouble hearing you.
Okay, can you hear me now?
A little louder.
Okay. I'm Steve Finder. I lead the private equity practice for Focus Search Partners. We're a retained executive search firm. We're in 9 offices across the U.S., including Dallas and Houston. I'm in California. We focus on portfolios of private equity companies, technology, industrial, health tech, and healthcare, and some other areas. And we're owned by a $750 million human capital services firm with a strategy group as well. And we're excited to be here, and thanks for including us today.
Awesome. Thank you so much, Steve. We'll move right along here to 4 Degrees. Ablord, if you wouldn't mind introducing yourself and your firm, please.
Sure thing. Hi, everyone. My name is Ablorde. I'm the co-founder and CEO of 4 Degrees. We are a deal flow and relationship intelligence software built for the private markets. So we have about 100 customers today across the private market spectrum. So think private equity, independent sponsors, investment banks. And we combine automation to eliminate data entry about your team's relationship network and deal flow, along with actionable intelligence to help you leverage that for your advantage. So everything from detecting deals that have been done in your relationship network, relationship strength detection to find your strongest path into companies, and a number of other tools to help you drive deal flow in this market. So happy to chat with anyone after this, and looking forward to engaging.
Thank you, Ablord. I appreciate that. We'll move on to Resourcive. Nick Creasy, if you could introduce yourself and your firm, please.
Hi, thank you so much. Happy to be here. Nick Cressy, Managing Director at Resourcive. We are a spend reduction and optimization firm, primarily focused in private equity space, middle market. Right now, currently working with between 60 and 80 firms. And right now, the name of the game is immediate cost containment and spend reduction. So that's where we're focused. Looking forward to speaking to you guys later on today. Thanks for having me.
Thank you, Nick. We'll move along here. We have 2 other sponsors, but both of them are on the panel. So I'm just going to acknowledge them. And then when we get to introducing them, I'll allow them to, of course, introduce their firm, Frisch Capital Partners, as well as Polsinelli. So before we begin, we do have a few poll questions that we'd like to ask you as the audience. Please do participate in these. These are helpful for us to know where you came from and who you are. So the first one is, how did you hear about today's event? You should see a dialog box pop up there on your screen. Feel free to just mark your answer. We'll give you about 10 seconds or so, and then we'll move forward to the next one. Great. Good. So a lot of you heard from us. I'm sure a lot. Thank you for joining us. Some of our speakers help promote, as well as our sponsors, a bit of LinkedIn, so we appreciate that. We'll move on to the next question here, which is, which of the below best describes you? Are you an independent sponsor, an investment banker, capital provider on the debt or equity side? We want to know. This is helpful for us to know internally, but also for our panelists to know who they're speaking to as well. Give you a few more seconds here, and then we'll share the results. Great. So it looks like good deal of independent sponsors. We're doing an independent sponsor deal connect after this, so happy to have you all with us. Some investment bankers, people on the capital provider side as well, and a few of our sponsors and service providers. So thank you guys for joining us today. We have one more question that we'd like to ask you, and this will be discussed as we move forward in the conversation. But how long do you think this recession will last? 3 to 6 months, 6 to 12 months, 12 to 24 months, or over 24 months? We're curious to hear your thoughts. Okay. So it looks like majority of people are seeing that as 12 to 24 months. About 50% of you, 35% think 6 to 12 months, 10% think over 24 months, and 6% think 3 to 6 months. So panelists, something to think about as we move forward. But without further ado, I would like to introduce Rick Jordan of Polsinelli. Rick is going to be our moderator today. They are also a sponsor. If we weren't sheltering in place, we'd be in their office. So appreciate your support, Rick. And I'm going to turn it over to you and bow out now. So thank you.
That's great, Lena, and you've been wonderful in helping set this up. I know that I particularly have been a pain in trying to get some certainty on how this cyber webinar works and some of the fatal flaws. So appreciate your patience with me. So I'm Rick Jordan. I'm a shareholder at Polsinelli. We are a longtime supporter and big fans of Opus. It's been just a really wonderful organization for us to be connected with. Polsinelli is an AmLaw 100 full service law firm. We've got offices everywhere, including up the coast. I would say that most of our action is sort of between the goalposts. We've got a middle market focus. I'm resident in our Dallas office, where we've sort of got a growing portfolio of investment fund clients ranging from growth equity to private equity, from lower middle to middle market. And we also do a bit of work with independent sponsors. Our private equity team of late has outside of crisis management, has really started ramping up the distress side of our practice. But we formed a number of new funds of late that have a broader, sort of more opportunistic strategy as an effort to sort of increase flexibility in capital deployment in this new phase. That said, it appears still to be kind of a wait and see approach for actual deployment of that capital, and we'll talk about some of that during the session. So with that, I pass it off to Blake with River Associates to introduce himself.
Great, thanks Rick, I appreciate it. And thanks for letting me join this panel. Blake Lewis, Vice President at River Associates. River is a lower middle market private equity firm that's been around for over 30 years now, solely investing into lower middle market businesses. We've made almost coming up now on 100 buy-side transactions across 7 committed capital funds, our latest fund being $285 million. We have 8 active portfolio companies today. We're a generalist group. We'll invest all across the US and Canada. We mainly focus on manufacturing, distribution, some business service, industrial service businesses that range anywhere from platform investments of 3 million of EBITDA upwards to slightly north of 10. So that's a quick rundown, and yeah, thanks again, appreciate it, look forward to the discussion.
Absolutely, thanks Blake. Drew, say a little bit about yourself.
Hey guys, Drew Brantley here with Frisch Capital Partners. I'm one of the managing partners here at Frisch Capital. We have, for over 20 years now, specialized in raising debt and equity for independent sponsors. So back before the term even existed, we were helping raise capital on a deal-by-deal basis for folks to get done. So seen a lot of things in a lot of different industries, kind of keep a very good pulse on kind of where the market is, and we'll talk about some of that today, obviously, as it relates to portfolio companies, et cetera. But if folks have specific needs or want to talk about stuff specific, would love to talk to you offline.
Great. Thank you, Drew. Lilies with Accord.
Hi, my name is Lilies Lanway. I am Accord Financial. I'm the Senior Vice President, and I am the head of the business development for the company. We are an asset-based lender doing transaction 1 to 20 million, publicly traded in the Toronto Stock Exchange, and I think we celebrate 43rd year this year. A significant number of our transaction is with independent sponsor, last count was about 62% funding the acquisition. And the balance is also a significant number with funded sponsors financing the the restructuring of the portfolio companies. So yeah, we fund on receivable, inventory, and make term loan against equipment and machinery. So I appreciate being invited on this panelist, and look forward to our conversation.
Great. Thank you, Lilies. Well, I believe that today is National Nurses Day, so a big thanks to our frontline workers, for those of you who have family members in that line of work. We have, as a panel, sort of talked about some rules of engagement, what we want to cover and don't want to cover as we sort of talk about the capital needs of portfolios in the midst of this pandemic. And the one thing we're not going to cover, if we can help it, is PPP, Main Street lending. I think we've all gotten our fill of that over the last several weeks. A couple of us on the panel have small kids. The Blue Angels just flew over my place in Dallas, and my kids are running around the backyard, with their arms stretched out. So I'm going to apologize in advance if I have to strangle a kid while on this webinar. But please submit questions real time. We'll try to make this as interactive as we can. There's a function at the bottom of your Zoom screen that will allow you to do that. And I'll try to monitor that throughout the panel. Like I said earlier, I've done a number of these events with Opus and have had the good fortune of having Lilies on many of those panels. And so she's always got wonderful perspective generally and relative to lending specifically. So why don't we start with Lilies and open it up to her to talk a little bit about what Accord has been up to of late.
So as it relates to COVID-19, it's become a very important part of our discussion. I'd like to address it in two ways. The COVID-19 has become a filter, a quick filter for us. Certain industry we no longer have appetite for. So if that deal comes in because of COVID, we said, nope, we have no appetite for that. For the one new credit, it becomes a very big part of our write-up in the credit memo, addressing that in granular about the effect of the company, of the business, the industry, including discussion about not only how have they been impacted, but what are they doing to ride through the storm, and what are some of the plans they are planning or is implementing when we get out on the other side, and touch a little bit more about, what happened if this research come back again in the fall, like many people think it will be. It's becoming a very big conversation. I mean, it's very interesting. 3 months ago, before all this, in our credit memo, we don't have this section about COVID discussion, but now it has become a very major part of our consideration.
And Lilies, what are you hearing from your existing sort of borrowers, and what is it that you should be hearing and would like to be hearing? Is there any disconnect? We'll hear all kinds. We are in touch with our client on a weekly basis, having a conversation. Of course, first and foremost, we want to know about on their cash. That's very important now. I mean, profit is really an opinion, cash is real fact, and how are they going to be able to ride through that? That's very critical. We also like to see, what are you doing to cut costs? Are you cutting costs in the right places? For example, we have a client that cannot really cut costs on certain department because they need these skilled employees, so that if it comes back to start the business again, they don't want these people through the competitors. So we look for that. We also look for the consultant. If they have consultant helping them to start with, we don't really like to see them cut that either, because they are integral parts. So we look into we want to see them cut costs, but we also want to know where are they cutting the costs and how is that impacted the business.
it's very interesting. What are they saying to us? Well, depends on the management. Some management is just right on the ball, anticipating our question and addressing that before we ask. That's the best kind.
Right.
That's a way to build confidence and sticking with them. We also have conversation about, well, how do I plan for COVID-19? Well, I don't even know, are we going to go back in business a month from now, or is it going to be 2 months from now? So they've been asking a lot about, how about covenant holidays? We've done that. We also deferred some of the principal payment. We've done that. The bottom line is we just don't want to test the value of collateral at a time like this. So for companies that are deserving to stay in business, we will do everything that we can to help them. And the key to it is talk to us.
Right. And Accord is traditionally an asset-based lender. And are you having to look beyond asset values in this age of the pandemic and focus on cash flow?
Well, as far as availability, we don't really do a cash flow lending, but when they need more liquidity beyond the formula, we have to do that. Again, what we don't want to do is we find ourselves putting ourselves in a situation where this is not the best time to foreclose.
Right. Absolutely. And from an underwriting perspective, in terms of new originated loans, are you making any assumptions relative to COVID that portfolios ought to have on their radar, including a possible resurgence of COVID this fall?
Yeah, so we wrestle about that. The way we judge how prepared are they on the resurgence is how are they managing it right now. If they're fumbling right now when it comes to resurgence, they probably are going to be in the same place. But on the other hand, we all be mindful that because it's so much unknown, if you prepare on the resurgence and you bake it into your plan, you probably are 50% wrong, going to be 50% wrong.
Right.
So sticking it really close, keep it close to our chest, communication is very critical for us. Do it day by day, week by week.
And have you seen any new deals land on your desk from other lenders, sort of getting cold feet on deals?
I have one right now that they were ready to close in the month of June. He had lined it up with for the term loan as well as the revolver. The term loan was through is an acquisition of an independent sponsor, to be relevant here. He has lined it up with the equipment lender on the sale leaseback basis. And last minute, they decided they don't want to fund anymore. It was interesting noted that the equipment lender saying, hey, we need to preserve cash because we're expecting our client going to be delayed in paying their monthly payment. And so we're not taking any new one. And as far as the revolver, it was from a bank-owned revolver, ABL. And they just say, hey, we got a lot of stuff going on in here. We're not taking on a new client. Yeah, I have one right now.
Got it. Well, the debt side is interesting. A number of sponsors have been focused on that. I think it seems to me that a number of the sponsors' portfolio companies have done a good job of loading up the balance sheet with cash, navigating the PPP process, focusing on their business continuity plans and sort of planning for when, the coming months and hopeful some, resurgence of activity. From a debt perspective, have you seen just generally that portfolio companies are doing enough? Do they have enough cash on their balance sheet? What are some, and if not, what are some of the weaknesses that you see?
Well, I can say that the healthier company going into COVID are drawing down availability big time, just to put cash on the balance sheet, and they're paying for that. We're not a bank line of credit, so we're not as cheap as the bank, but they rather have that cash on the balance sheet. Now I can't, speak for themselves, but I surmise that they're saying, before my balance sheet deteriorates, let me get the cash and availability, because my lender is probably gonna ask me a lot of questions if I ask at the wrong time or when my balance sheet looks uglier than when we just started. So yeah, we do see companies that drawing down.
Right.
And we have to strike a delicate balance too. If the company has margin to do that, we gladly to do that, and we trust the ability to repay. But if the company is on a pretty thin margin, it causes us to pause. If I give it to you now, am I going to get it back if things go sideways?
Right. Well, why don't we bring Blake into this discussion and hear from sort of the sponsor side, and it's kind of a similar question. You've seen firms have kind of generally helped their portfolios with business continuity plans, loaded up the balance sheet, navigated some of the Main Street lending program stuff, and now sort of forecasting for the balance of the year. Kind of what are you seeing, and what are some of the bogeys that need to be on everyone's radar?
Yeah, sure. A lot of what Lily said it pans out for us as well. We have a lot of businesses that took down what lenders are calling security blanket revolver draws. Almost all of our businesses did that, and having liquidity is the most important thing in this environment. Making cash is king. So, in terms of forecasting, and it's moved from a budget look, looking at the beginning of the year, how is the budget going to pan out, and are we going to achieve that budget? It's now gone to a short-term aspect. We're focused on, the next couple of weeks to months, as opposed to, how's fourth quarter going to look? No one knows, right? No one really knows. So we're doing 13-week cash flows with, frankly, all of our businesses. And they're all different. They all have, different leverage. They've been impacted differently from COVID. They're all being impacted. Every business is being impacted, just different degrees of severity. But that, we're shortening that forecasting to looking at the near future. Do we have enough liquidity? And, we're in preservation mode, I'll call it, for really all of our businesses. We've turned off pretty much across the board all non-essential spending. And so, they've had to make some tough cuts, unfortunately, as part of that as well. But again, it's preservation mode.
And have the lenders generally been accommodating in dealing with this? Any specific issues you've had to deal with on the debt side?
No, not yet. And not suggesting that we're going to, but we, it's just early. Lenders and Lilies can opine or weigh in on this as well. I mean, no one knows exactly the extent of what we're going through currently. Is the economy going to come back online quickly? You always hear is it going to be a V shape? Is it going to be a U shape? Is it going to be a W? No one really knows, and lenders, frankly, don't either. They, we're a highly transparent group. We communicate with our lending partners in some cases, and certainly weekly, giving them flash reports and snapshots of our, the businesses and how they're performing and what measures we're taking. We always find that, being a highly transparent is better for everybody. Even sharing bad news early is better than keeping it and waiting. But we haven't had to work through, and hopefully don't have to work through, really tough conversations, but it's too early to tell.
And have you had any portfolios in need of equity checks in terms of asking for more sponsor dollars and rescue capital or just additional equity infusion?
We know that can be that's something that might come down the road. The short answer is no, we haven't. But I'll say, we've got 8 businesses. They all matter to us. We don't have 50 across, multiple funds. We're investing out of one fund right now, but we have 8 companies. And they all matter. We're going to support them. So, it's a conversation that we've discussed internally at partners meetings, and making sure that we know that that's a potential down the road, but we haven't done it yet.
So Rick, I want to add something and emphasize something that Blake just said, because you mentioned, Blake, that it's kind of too early to tell for some of these situations, and I would echo that. So Frisch Capital, in addition to raising capital for transactions, we also help with capital needs long-term for portfolio companies of independent sponsors or capital providers that we work with. And what we've observed in the, I don't know, almost now, I guess, over the past 6 weeks, the 100+ conversations we've had, most companies had plenty of backlog through March, and then a lot of them continued backlog through April. So a lot of them have just kind of worked through their backlog, or still kind of on the tail end of that. And so I really think May and June are when we're really going to start to see where is some of this, how are some companies really beginning to be impacted. And so, additional capital needs, whether it's debt or equity, I think that's when we're going to start to see more of that effect. And Blake, your phone might start ringing, or other people, for additional capital needs like Lilies. Because I think that's when it's really going to start to manifest itself, because based on a macro level, do we find a vaccine? Do we find an antiviral? Does consumer confidence go up? The faster those things happen, I think the faster that recovery, which a lot of people have talked about, but, we've shut down a quarter of the economy, to zero. And I think as somebody said a minute ago, there's no way to plan for that. And so for a lot of companies, how that recovery fully happens, we don't know yet.
Yeah. Drew, that's a good point. We and Rick, we've shared, forecasting models with our lending partners, and said, hey, do you want to start discussing, covenant levels and that kind of stuff? And the early feedback has been, let's wait and see. How long does this play out? Are we going to reset covenants for Q2, 3, and 4, and have to revisit them again right out of the gate? Let's try to avoid that. And they don't want to go through the headache either. And frankly, and I can't speak for all the lenders out there, but the ones that we talked to are still trying to figure it out themselves. They want to, how are they internally going to address this from a covenant perspective? Because a lot of borrowers are going to be having these conversations. I mean, companies are being, as everybody knows, severely impacted.
Right.
We've even seen that, sorry to jump in, we've even seen that, Blake, too, down to the vendor level, whether that's the, vendors for existing companies and their payment terms, and then also to, landlords if they're leasing or renting property, because, those that are healthy, the general consensus folks have said, if you can keep paying, to kind of keep the whole life cycle going. But if we need to start having a conversation, we can.
So Drew, when you think about taking some of these portfolio companies that might need an outside equity infusion, or potentially just exit the company from the portfolio, from a it's kind of a process standpoint, as a banker looking at that in light of COVID and the shelters in place, and prepping a process and preparing a company for diligence, can you just kind of walk us through your thoughts on that, and how you guys are working with portfolios in that respect?
Yeah, that's a really good question. I think, right now we're just starting to see the faucet turn back on a little bit from a new deal perspective. And I think May 1st was kind of a big date in our mind, of where most people have fought the fires in the portfolio companies, now can start looking to put money to work again. And so to use the Caddyshack analogy, it's like the Gophers just stuck his head out, and they're trying to see where the groundskeeper is, and kind of get a lay of the land. And so I think we're starting, we've got a few deals that we're working on, but we're just looking to start bringing those out in the next couple weeks. I think a couple things around that, and I'd be curious, Lilies, to hear from your perspective as well. But I think as we look at projections, there's a huge question mark around projections. So being able to underwrite that best as possible, and any supporting data is always helpful. The other thing is during due diligence, we're going to see, in my opinion, a much higher frequency of communication, just kind of like Lilies was indicating. They're talking to some companies on a weekly basis or even daily basis if needed, instead of kind of once a month getting an update on where did last month's numbers come in. It's going to be, where the last 2 weeks, where was this week, and how do we really pay attention to the small changes in things as the companies are moving through a process. And the other thing is I think inherently by the nature of where we are in a lack of being able to grasp kind of the macro situation, there's going to be more risk in processes currently than there was, 6 months ago, which I know is a statement everybody's aware of, but I think the ability to underwrite the pipeline and the backlog and kind of the end markets that you serve is going to be really important. And we haven't really, kind of touching on valuations real quick, and then I'll, pause and let somebody else talk. But, valuations we haven't fully seen begin to drop yet, but I think it's about to happen. But I think really it was partially based on my comment of, we just finished 19, so to speak, and a lot of people still had really robust backlogs coming into 2020. And so people, I think, are just now starting to work through those. And the real big question is, who stays in the pipeline going forward, and what's that new business pipeline and backlog look like? So
for some of the smaller, more closely held companies or family-owned companies that have a particular number in mind for their eventual exit, how do you manage expectations from a valuation perspective in the current environment, to the extent that those companies either need to go to market now or maybe don't need to go to market but ought to be thinking about it?
Look, it's a great question. I think the way that we are thinking about that at the moment, and this might not be, the best answer, but we're trying to shoot people straight and say, look, if you've got a number in mind, if we think that number is within a realistic expectation of where the market might be based off that company and their end markets, and kind of what the company looks like, then we'd say it's still worth taking a swing at it. If they're interested or taking it to market, if we think that number, a lot of sellers do have that number, and it's less. They don't think in multiples like a lot of us do. They don't even think about an EBITDA half the time. It's not a phrase most folks are using their vernacular. And so, I think helping them understand that we're doing a lot of education with folks, and what happens in this type of environment versus another. Is this the time to sell? And also, I think too, having to help sellers realize, and closely family-owned companies realize that, some of the answers you might have gotten away with 6 months ago, you're not going to be able to get away with now. Not that trust me is ever acceptable, but, in a bull market when things are going and everything's flying, people are a little more lenient in maybe some of the details around specific due diligence questions. I think we're going to see a lot less of that coming out of it.
Sure.
I think going forward, we're going to have.
We've got a question from Sandy Garrett that came over the Q&A function, and asking if anyone is seeing any sponsors effectively abandon their portfolios to their own fate, and what that looks like from time and advisory standpoint, and the extent to which sell-side advisors are being engaged. So if anybody's got commentary on that, feel free to answer live, or if any of our panelists want to jump in on that one, please feel free.
Yeah, I think maybe I'll just quickly weigh in. Lilies might be the most appropriate, frankly, just because of dealing with multiple sponsors. It'd have to be a business that got so impacted that you see no end in sight. That'd be a terrible situation, given this has gone on for only 6 weeks or so. to be that severely impacted. I haven't heard of any. I've got a network of folks that we stay, in touch with. And everybody that I speak to in the lower middle market equity groups that are similar to River, it's the same boat. We're all just trying to make sure that we have the liquidity for to weather the storm, however it may last.
I'll jump in. We've had numerous conversations on that topic with both capital providers and independent sponsors, kind of opportunistically trying to get a pulse on stuff, and then also people that we think might potentially have that situation arise in their portfolio. I think at this moment it's too early to tell. I do think it's going to start. I do think some of that's going to come out in the marketplace, especially folks that were willing to do some higher leverage and they were already at 4 or 5 times, and companies were impacted more than we ever imagined, or modeled that something could get impacted, were all of a sudden impacted. And so I think there are certain industries and end markets, especially in the multi-unit and the retail and the restaurant space, where those limits are really being tested right now. I think some of that, I haven't heard of anybody yet. I echo what Blake said. Nobody has bailed on any companies yet, but I do think that there's going to be, over the next 6 months, there's going to be multiple opportunities that come up, or situations that come up where folks just say, look, at some point, you got to figure out, how do you stop the bleeding? And unfortunately, I think that's going to come out.
I think there's going to be a lot of lender-owned. Go ahead, Lilies.
I'm sorry. I have heard, not from independent sponsor, but private equity with funded, and just say, look, our heads are down looking at it, and that we're in a triage mode, and there are companies we're just going to let it go. That's just the bottom line. I think most of those are probably going to be the ones that pre-COVID is already difficult, and then putting more good money into bad is probably the decision that they need to make. And they tend to be on the larger fund, so that one of them go south, or 1 or 2 compared to 10, 15, it probably is not too bad. I think it's great. I think it's a great opportunity for independent sponsor to call on to those big funds and say, hey, do you have a company? They won't admit it, I don't think, that they're going to do that. But I think it's an opportunity coming down the pipeline. I want to echo, your point, Brent, that there'll be some coming out. Drew, you mentioned that, right?
Yeah. Oh, definitely. Absolutely. And Lilies, I think you bring up a really good point. And I think it's a great time for independent sponsors because we're working with a handful of independent sponsors right now. A lot of funded sponsors, sorry guys that are on the phone or on the call right now, but they're managing portfolio companies. They got bigger fires to fight right now. And so the BD and the new business side has been much tougher. And so a lot of independent sponsors that we know and are actively working with have taken this time to build relationships with companies, with management teams, with sellers, with bankers as part of a process, to get a foot in the door. And some of we're already starting to see some of that paying off in terms of what people are involved with right now. And, for those independent sponsors that do the distress side of stuff, I mean, to Lily's point, that stuff's going to come up. So the more you can start to show your value add and get involved. We've talked to a couple people even that are, offering consulting services to those companies right now, kind of pro bono, with the idea that if they do go under and they can't be salvaged, or not go under, but if the investor chooses to let them go from the portfolio, essentially walking away, they've kind of got a first, foot in the door, for a process. So.
And to the extent that we do see some opportunities arise for independent sponsors, given just the triaging that the more traditional sponsors are doing right now, do we think that there is an availability of capital to those independent sponsors, particularly the emerging sponsors, on the equity side? I mean, I think, the debt is highly dependent on the situation, but is there dry powder that's interested in doing these deals and getting behind independent sponsors in this environment?
I from my perspective, 100%. I mean, I get multiple calls a day and probably a dozen emails a day from equity capital providers or people that do equity, whether it's debt or equity or just equity, that work with independent sponsors saying, hey, we're here, we're looking for deals. I mean, we're coming off of, I mean, at the end of 2020, there was more capital in the marketplace, than ever, and more dry powder and that money still has to be put to work. Now, it doesn't mean that it's going to be put to work in stupid ways or, without doing due diligence. So I do think, it still depends on the company, the end markets. As I think Blake and Lilies both indicated, they're not going to put debt or equity into just any company. So they're not going to give it out willy-nilly. It's still smart money. Yes, there is money to put to work for opportunities. I think the key thing coming into this is one, a couple things that I would just point out is, one is insights into the operation, the pipeline, and the backlog. I know I already said that, but that's going to be really huge. The ability to underwrite, any type of projections or end markets is going to be huge. And then, gosh, I hate it when this happens. I just had this moment. Come back to me. Sorry, guys. I didn't get a lot of sleep last night with my daughter, so I'm
no worries at all. Well, I mean, I think the points well taken and received. I think when you also consider the extent to which some of the traditional sponsors are just continuing to triage their existing portfolio and get a handle on it. Certainly, there'll be opportunities for independent sponsors to jump in on deals that they otherwise may not have had an opportunity to bid on. But outside of that, once the sort of triaging gets under control at the traditional sponsors, at least within my client's portfolio, I mean, we're talking to funds who think that they traditional buyout fund looking for control position, but in this environment are starting to have conversations with their investment committees about potentially doing minority deals and taking down 30-40%, in a preferred structure, participating preferred potentially, and with full exit rights, and some the appropriate blocking rights, potentially redemption after a period of time. Curious as to whether anybody is expecting that as well, or even seeing those deals.
Can I jump in real quick and just mention one thing? I remembered the thing I was going to say is it's, the third thing that I would say that's really important is the value add that the independent sponsor is bringing to the table, because I think it can manifest itself in a lot of ways. But, value add for deals, I think in the near future is going to be really important. And then going forward for independent sponsors. So really thinking about what is it I'm bringing to the table, whether it's C-suite or operating experience, vertical expertise, industry or operational, transaction experience, it's relevant. A lot of ways that can manifest itself, but that would be the third thing. Sorry. And then back to your minority question.
Yeah, that's great. That's great. Maybe Blake or Lilies on the minority deal. Have the expectation of seeing those?
I'm not sure.
Go ahead, Lilies.
No, I was just trying to, can you repeat the question again?
Yeah, it's just the extent to which we might see, traditional control firms, once they cease the triaging and get a handle on things, start looking at minority positions for companies that otherwise may not have gone to market for another couple of years, but with the pandemic may need to, load up a little more cash just to weather the storm.
Probably Blake is a better one to answer that question.
Yeah, so we're a majority investor, so we haven't had that discussion. I don't think even our LP documents allow us to. It's not what we've told our LPs we do, or minority deals. We're trying to take a different angle, and that is, we have certain deals that are under letter of intent right now. It's hard to underwrite the deal today versus what we thought it was a few months ago. And so what do we do? And in our strategy, a lot of folks are trying to put in place structure, putting an earnout and sharing the risk of the uncertainty between the buyer and the seller. And that's a hard, even in this world that we're in right now, that's a hard thing to get agreed upon, especially with investment banker intermediaries, involved there, Drew. And so to sort of entice or try to persuade we've tried to team up with, a lot of our deals are senior mezz. I know a lot of equity groups over the last 5-10 years have gone the unitranche route. We have, right or wrong, we've typically erred on the side of conservatism and went with a senior sub approach, and having some more patient capital in the structure from a debt perspective has been our strategy. It's worked well for us over 30 years, and we just haven't changed it. But we've talked about teaming up with those mezz groups and taking the financing contingency off the table.
Sure.
And so we'll put in place a structure, and we'll tie it to 2021, where hopefully things are back to normal. And who knows what 2020 is going to be. And so that's a strategy we are frankly currently trying to work out with a few deals. We're just not, unfortunately, I couldn't answer your question because we're not set up to do minority deals.
Sure thing.
We're seeing a good number that have that flexible mandate, that have a little more flexibility with their LPs, that are trying to get their foot in the door with that, and whether it's provide short-term cash capital needs. I would say that's more of an angle versus liquidity for the family, maybe a little bit, but I think a lot of folks are seeing it as a way to shore up a company without having to add additional debt, but getting their foot in the door to where there is the opportunity to have that relationship in place and maybe take it from a control perspective 3 years down the road or something like that.
Right.
A second part of the transaction. So
well, we've got another submitted question in our Q&A feature. It's from the anonymous attendee. And the question is, for deals where the purchase price was negotiated at the beginning of the year, is the panel seeing investors requesting a reprice before close?
I'm seeing that.
Yeah. On the first part of the answer is those deals are almost all, at least what I've been hearing in the market, is deals have just been put on hold. And so if they were priced, in February, and then, getting close to closing, March hit, uncertainty just delays the process. We're seeing LOIs get extended, through summer. And it's hard to go to them with a price decrease. And so that's why we've, as I said earlier, have been focused on more of trying to put in place some structure and keeping the price where it is, but just deferring it to a later period. So that's been our approach. We've heard others that are, willing to continue to do the deal even in this environment, but at a lower price. And so we haven't taken that approach, but certainly I've heard from many folks that's the approach they're going.
I have, and it depends on the industry. For example, the one I want to bring an example is in the aerospace industry. And then a big part of the business is serving the commercial airline company. And so we know the impact on that's going to be. So the purchase price they negotiated before COVID and leading through this is two different numbers. And the sponsor is willing to walk away because of that. And I think that's a smart move from their end, because they don't want to buy something and then get into it. One of the things that really we notice on the independent sponsor deal is they don't really have all the information with them when they bought the company, and they have the full extent of the condition of the company is after they own it, after they come in and do their integration or whatever that is, then they learn about what exactly they bought. And so for us, it's even more important for independent sponsor to be very conservative about that, especially in the industry that is hit hard.
I think we're definitely going into processes right now, eyes wide open, that's a possibility, and kind of telling all sides, because it is, we've kind of said, and everybody's heard a million times, we don't know the full impact of this. And so, if at a macro level things start to turn around and we've got more, line of sight that things are going to move back in the direction towards normal faster, then I think people are going to be much more amenable to, keep prices more in a range of where they were at the beginning of the year. But especially for those markets, like Lilies was just saying, I mean, if you're getting the, kicked out of you right now, or, your income went down to zero or something close to it. I mean, it's just a different business.
Right.
You don't have the staff, you don't have the infrastructure, you don't have the vendors, you don't have the supplies. Like, it's, in a lot of ways, companies are going to be starting over.
Yeah, it's very industry driven is what I discovered. Like, firearm, ammunition, they're going great. A lot better than before COVID. I mean, before COVID, we have a rather difficult conversation. After COVID, man, that thing is flying off the shelf.
No doubt. Well, for the other companies who are struggling, have any of you seen companies pursue business interruption claims against their carriers? I'm starting to see the plaintiffs bar reach out and to try to drum up some business in that respect, and curious whether anyone's had success on that, at risk of opening the floodgates, because that could be a whole panel in and of itself.
That is a topic that we have explored at all of our businesses, and we have had initial conversations. So it's not necessarily a topic I'd want to go into in great detail, as you said, just because I'm not sure exactly how it will play out. I mean, our early thoughts are it's going to be a tough argument to win, given how the policies are written, but it's certainly something that's being explored.
Well, great. Well, we're right up against our time limit. So what I would I ask of each of our panelists is maybe provide some last words, concluding thoughts to our attendees.
Yeah, I'm happy to, and maybe go in order here. I think I have maybe 2 or 3 things I'd want to share. One is, private equity's been around for 30 or 40 years, and been through cycles, been through the 01, been through 08, been through even earlier in the 80s, and has persevered, and I think that's going to happen here. I think it'll be another one where down the road it'll always be the questions we ask the investment bankers, instead of how'd the company do in 08 and 09, how'd the companies do in the COVID time period. But the 2 main things that we have found, with our businesses that are the most important for us is sort of 3 things, I'll call it, is we're glad we put in place conservative capital structures. The times we over-equitized a couple deals have been beneficial. And so I'm glad we did that. Taking down 6 times leverage, just because you can, at the time may seem appropriate, but again, it's times like this that we're glad we don't have that strategy. The other 2 main things are having an e-commerce strategy at all of your companies is extremely important. We go into that as part of our diligence in evaluating the e-commerce strategy, and that one just went to the top of the list in terms of how we focus and dedicate our diligence. And then lastly, having a solid management team, an experienced management team, a good management team, it has been the most important thing I think that we've noticed as part of these deals. The ones that can make smart, quick, but smart decisions, that have been through recessions, and know how their business operates, what changes need to be made. That's going in. So if you're looking at new deals, evaluating the management team as much as evaluating the core business is extremely important.
I think we're about out of time, so maybe we'll just leave it with Blake on the concluding thoughts.
Thank you, Rick. I want to thank all of you guys again, Lilies, Blake, Drew, and Rick. Appreciate your contributions to this discussion. I think it was very insightful. Thank you to all of our participants for joining us. As you can see on the screen, we have a few more webinars coming up, so stay tuned and check those out. Again, thank you to our sponsors. If you are participating in the Deal Connect directly after, log out of this link and please log into your now Deal Connect link. We'll go ahead and get you situated and try to start on time. So again, thank you all so much, and we'll see you at the next one.
Thank you.
Thanks, everyone.